Hello, everybody. This is Professor Lambert on business valuation of privately held companies. This is lesson number 6. What we're going to be discussing in this lesson is the cost of capital. And again, capital consists of debt capital and equity capital. So why do companies need capital? Well, the first reason they need capital is because to do whatever they're going to do, they need to acquire either equipment or hire people or a combination of the two, most likely. So if we think about this on a very simplistic basis, if I were running a coffee company, what would I need? I would need equipment. I would need some coffee machines. I would need a location. The location can be as small as a shack. I've seen this, like a very tiny, looks like a tiny house that you could probably fit 3 people in. And I've seen this be a large location that has not only coffee, couches and chairs and tables and things like that. And I've also seen this as a cart. When I went to school in New York City, there was a guy who pushed a cart down the street, had a couple wheels, and he was able to brew coffee on that and sell it right in front of the school I went to. So that was an interesting thing. And you can have a coffee truck now, like a food truck. And those are out there as well. So again, companies need cash or capital to start their business. You might have also heard the phrase, it takes money to make money. It's a little bit about that. You have to start with money, invest in some things, and then use those investments to come up with a product or service where you can make more money, or turn that money into additional money. And when a business fails, people put money into the business, and if they lose it, they might lose everything they've invested into the business. So that's why business is a risk-reward proposition. As such, people who invest in a business want to know, what percentage rate of return do I need to earn on my investment? So if somebody asks me to buy a business and I pay $100,000 for that business, well, what if I lose $1,000 every year on my investment? That means my investment rate of return is like -1%. I put in $100,000, I'm losing $1,000 a year. That was not a good investment for me. Some people say, hey, if I buy into this business, I want to earn at least 20%, meaning I want to put in $100,000 and I want to make 120, or I want to have 20,000 every year for the next X number of years, and I want that to grow, of course. So whenever you invest in something, you can think about what percentage rate of return would you like to earn. And there is a simple thing called the rule of 72, which has to do with how long it takes your money to double. So the rule of 72 says that if you take 72 and you divide by your investment rate of return, that tells you approximately how many years it'll take you to double your money. So if I could invest in something where I earned 10% a year, what that would mean is I'm doubling my money about every 7 years. So my $100,000 investment, if I was earning 10%, in 7 years, I'd have $200,000. That'd be my net worth of that investment. If that doubled again in another 7 years, I'd have $400,000. So that's an overly simplistic way to look at it, but that's what the rule of 72 is, if you ever happen to come across that. So obviously people want to earn a higher rate of return, or do they? A higher rate of return is great, but oftentimes you have to take a higher level of risk to get there. So what we're going to discuss in this chapter are the components of the rate of return. And let's talk about the cost of equity. The cost of debt, we can actually precede this a little bit by talking about the cost of debt. The cost of debt is simply, what does it cost me to borrow money? So if I think about the things I bought in life that required me to borrow money, it was an education, a car, and a house. So, and a business too. That was the fourth thing I bought. But the first thing I bought was an education. So what does it cost me? You can think about what your student loan is. That's the interest rate you're paying on those loans is the cost of borrowing that money. Now, when I bought my first car, I borrowed money to do that. I saved some and then I borrowed the rest. And the car people told me my borrowing rate was X percent. So that was my cost of debt. When I bought a house, there was a mortgage rate, and that mortgage rate was the cost of debt. Now, for companies, when they borrow money, the interest that they borrow is deductible as a business expense. So when we get into the cost of debt, and we're going to talk about this more on the next slide, we always adjust that by making the pre-tax cost of debt into an after-tax cost of debt. So if I could borrow money at, say, 10%, and my company had a 30% tax rate, then my real cost of borrowing is 7%. It's 10% minus my tax rate of 30% is what I really am borrowing the money at. And we'll get into that more on the next slide. But let's talk about the cost of equity. Equity is ownership in a business, and we're going to focus primarily on common equity in this discussion, common stock. There is a build-up method that is used by appraisers to determine the cost of equity, and that build-up method has a few different components. We start with the risk-free rate. The risk-free rate is the rate of return that I could earn on government securities. So if I wanted to invest in something totally riskless, I could buy a U.S. government security. Why is that riskless? Because the U.S. government will never default on its debt. If it needs more money to pay its debt, it can just print more. Now that's a good thing and a bad thing, but this risk-free rate means this is what I would earn if I took no risk of default whatsoever. And that's often abbreviated RF. That's why I wrote that next to that. Next is what's called the equity risk premium. When I decide to invest in a stock, I'm now investing in equity. And now there is a risk of loss. The company I invest in could lose all its value and go to zero. So I need to be compensated by getting a higher rate of return for investing in a publicly traded company. And these numbers I've made up based on some long-term historical averages. I'll talk more in class about where you get some of this information. But for our purposes, if I can earn 4% risk-free, but then I decide, hey, I want to buy a company stock to take a little more risk, earn a little more money, now I'm looking at around a 10% rate of return to invest in a large publicly traded company. If I want to invest in a small stock, there's an additional premium for that. Small stocks that are publicly traded have more risk. They often earn a higher return. And that is about a 6% premium as well. So there's a 6% premium to the risk-free rate for investing in a large cap common stock. And then there's another 6%-ish premium for investing in a small company stock. And then finally, we have this component, company-specific risk. This is a additional risk that the appraiser or business appraiser would assess related to this specific company. In class, we'll talk about what some of those factors might be that lead to additional risk, but we're really trying to distinguish now. These are all generic rates of return: the risk-free rate, the equity risk premium, and the small stock equity premium. The company-specific risk is just what it sounds like. It's specific to the company that we are valuing, and we'll talk in class about what some of those items could be. So what this is saying is to invest in the common stock of a small company, including the company-specific risk, I would like a 17% rate of return to invest my money in that company's equity. And again, our good old rule of 72, what that means is I would double my money every 4.25 years or so, if the investment went well. Now, there's no guarantees. That's just a quick way to think about. The higher the rate of return, the higher your money will double, the sooner it will double, but also you're taking more risk. Now this next slide gets into the weighted average cost of capital, and I'm hoping this is a review for most of you. So over here on this side, I've just reproduced that cost of equity of 17%, just so you can see that this is going to be a blend of the cost of debt and the cost of equity. Over here, we have our cost of debt. And so this company borrows money at a 7% pre-tax cost of debt. After taking into account that our company has a 30% tax rate, what this means is the true cost of this company's debt after taxes is 4.9%. How did I get that? It's 7% minus the 30% tax rate. So it'd be times 30%, which is 2.1. Sorry, this is not coming out well on the screen. I'm trying to draw with the mouse. So 7 minus this 2.1, which is 30%. That's the tax rate, is 4.9. And again, we're going to go over this in class in much more detail. But the after-tax cost of debt is 4.9%. My cost of equity is 17%. In the weighted average cost of capital, what you're doing is you're blending the cost of equity and the cost of debt to come up with an overall cost of capital for investing in this firm. So here, the assumed equity percentage is 50%, meaning this company finances or raises capital about 50% with debt and 50% with equity. Now, this doesn't always have to be 50%. Sometimes companies will have 80% cost of equity and 20% cost of debt. And we'll talk a little bit more in class about how we get to those. So now our weighted average cost of equity is 17% times the 50% equity weighting. And then our cost of debt is the 4.9% after-tax cost of debt times the 50% debt weighting. And then we combine these two, the 8.5% plus the 2.45% gives us a weighted average cost of capital of 10.95%. So again, hopefully for most of you, this is a review. If you've been a business major, you should have had this in your finance class. Deriving the cost of capital and specifically the weighted average cost of capital. Now, one final thing here. This is the discount rate that we would use to discount cash flows back to their present value. So in our DCF, or discounted cash flow valuation, we'd have our years of projected cash flow, and we would use this as a factor to come up with our the present value of those cash flows. We'd add those present values together and come up with a value. To come up with a capitalization rate, we take our weighted average cost of capital discount rate minus the company's long-term perpetual growth rate. Again, this is a number that is generally given to you, or you come up with some data to support this number. But this is deemed to be the company's long-term perpetual growth rate. Now, you may think 2.5% looks pretty high, but we'll talk about this more in class. If you have a much higher long-term perpetual growth rate, you see that a company can't really sustain that into forever. Even companies that start small and grow tremendously in their early years eventually reach some sort of steady state growth rate. The way you come up with a capitalization rate, or the cap rate, is it's the discount rate minus the long-term growth rate. So 10.95% minus this 2.5% equals the capitalization rate. The capitalization rate is used in the Gordon growth model, or what's called the dividend discount model, to take a series of historical cash flows and convert those cash flows into a value. And again, we'll talk about that more in class, and we'll also have some examples for that. So I hope you found this useful. There's a lot of quantitative information on these, and there's a lot of assumptions, so I'm sure you're going to have questions about these, and we'll discuss those questions in class.